Hello, I am making this video so that we can cut through all the noise and just get down to what infinite banking, personal banking, your private bank, and the Rockefeller system really is, and what it can do for you so that you can make an informed decision on whether or not this is the right financial vehicle for your needs. This is Dave Ramsey's Get Out of Debt on Steroids and an emergency savings account on steroids. You owe it to yourself to listen to this to the end. How would you like to pay off all your debt? Yes, all your debt in 10 years or less. Keep listening. First, I want to introduce myself. I'm Jeff. I'm here. I'm a cancer survivor for 10 years now, and I am fighting the cancer still. I have used this idea to rent a machine from Australia and to work with a doctor in Australia to help fight my cancer. I would like to ask you a favor. Please give me some leeway. Sometimes my brain and my mouth are not on the same page. I also don't have the energy like younger folks. What started this, what started me on this quest to help people prepare for life's curveballs is my wife had brain cancer when our three children were under the age of 4, and we were in our early 30s. In order to make sure I get all the information in, I am just going to stick close to the script on my computer. Okay. Are you okay with that? Okay. That's great. Now, so let's get started. Infinite banking, personal banking, your private bank, there are different terms, but it is all the same. Instead of telling you what it is, I found to describe it is to actually tell you what it does. So here's a testimony from one of our clients. Her name is Jamie. She's a nurse, and it's a little wordy here. So let me break it down for you. She had nearly 12 years of scheduled debt payments piled up in front of her for nursing school, loans, a mortgage, cars, credit cards. With my infinite bank, with her infinite bank, she'll be completely debt free in 4.5 years without adding a penny to her monthly bills. In 20 years, she'll have over $900,000 in assets. In 30 years, it'll be over 1.7 million. That's money is her additional retirement income. And it's all tax free. While the money's great, knowing that she will be able to cut back on her hours and have more time to spend with her family is what she really matters most. And just to take this a step further, just to share with you how we've been able to help some clients over the last 6 months. Well, we've been able to eliminate over 9 million of their debt, saving them in scheduled interest payments over $4 million and built over $90 million in their retirement savings. How would you like to be in that group? How would you like to have over $1 million for your retirement? And you can take money out of it tax free. Do you like that idea? I wish that this has been taught in high school and college, but it wasn't. So the next best thing is to learn it now. Let's keep going. Are you interested? All this is really coming down to is one basic question. If every dollar that you earned was suddenly worth two and all of your debts were paid off, would your life or would your retirement be more comfortable? I have to guess that you're probably saying yes, that it would. I've yet to run into that person who says, no, Jeff, I want to just keep adding debt on top of my plate, and I want to be paying off debt until I'm 103 years old. So let's get down to the fundamentals of the infinite banking, personal banking, and whatever you want to call it. First off, who uses infinite banking? Well, it started off 100 years ago with the Rockefellers. Fast forward a couple of years, and you've got Walt Disney taking a loan from his infinite bank and starting one Disneyland and Disney World. You've also got guys like Ray Kroc, who started McDonald's with a loan from his infinite bank. Now, I don't know if that's a good thing in your eyes or a bad thing, but after, however, many billions of hamburgers that have been served, I would say that Ray made a good bet in taking a loan from his infinite bank. Now, who's using infinite banking today? Well, you've got basketball legend Magic Johnson. You've got the majority of the U.S. Congress, and this is why the tax laws won't change, because they're using the tax laws. And you've got Warren Buffett, arguably the most famous investor on the planet. But you don't have to be a billionaire to use this infinite banking. You've got people like Nurse Jamie. You've got people like the rest of our clients who we have just helped. I just want to add in here that there will be another video on YouTube at the end of this one that shares about 50 major corporations that use this for their corporation. Also, a list of banks that use bank-owned life insurance for making their money also. Now, if the banks can use this, then it's certainly safe for you. Now, over $2 billion went into cash value life insurance in 2019 by folks and businesses like you. The money people had in their life insurance stayed there during the Depression and in 20 or 08. Can I stop what you're doing and just take an hour and listen to me about infinite banking because it's changing people's lives? That is important, right? So have I caught your attention? So when do you use infinite banking as a personal bank for your family? Well, it's ideal for families who don't want to have debt during their retirement years. They want to become their own private bank. And for those people who want to pay off their mortgage, their car loans, their credit cards, their student loans, their personal loans, anything that has an interest rate attached to it without adding additional payments every month. Now, are you with me so far? Write down if you have any questions and see if they are answered by the end. Now, I told you that I wasn't going to use a lot of financial jargon. I think that if you take the concept of infinite banking down to its very core, yes, down to its very core, The easiest way that I can describe it is to call it a savings account on steroids. Okay. The savings account on steroids does several things. Okay. First, it gives you a higher interest rate. First, it gives you a higher interest rate and compounded at that. It gives you a guaranteed growth if you use the infinite banking in one. It also allows you to use every dollar twice. Can you imagine if you take $1 and you use that $1 in two different areas? That means you're doubling your profitability, right? Do you like using your dollar twice? It, number four, it gives you access to your cash without penalty. No government as a partner. Get rid of the government. Get rid of the government, right? Certain financial vehicles like a CD from a bank, or maybe even an annuity, a 401k, or an IRA, will penalize you for taking your money too soon. Out of those vehicles, this is not the case within your bank of cash value. Five, five, it gives you the ability to generate additional income and growth, right? This is your side hustle without having to do anything else or else other than what we all have to do, which is finance our daily lives. Six, it gives you greater control of your money. Seven, it provides you tax-free income. Now, who do you think uses this? Who do you think uses this? Okay. It shelters your assets. It gives you the ability to create generational wealth. It grows tax-free. And you can make it grow hyperspeed if you want to. It does not go through probate. A lot of people like that. It doesn't go through probate. 12, it's not accessible for lawsuits or divorce. Oh boy. It is protected in most states. And I'm going to unpack that in the next few slides or the next few minutes. But ultimately, folks, I can't dance around this any longer. At some point, the rubber has to meet the road, right? What is infinite banking based on? Well, that's based on a participating whole life insurance policy or an index IUL. Now, before you start getting ideas or more flexible higher gains that you have to watch more with the IUL, cash value life insurance. This is not your parents' or grandparents' whole life insurance policy. No, it isn't. What we're doing is we're using the laws of the land and the U.S. tax code to create a protected and guaranteed financial vehicle or a bank that's wrapped inside of the life insurance policy. All right. You benefit from owning both. And while this does have a death benefit like traditional life insurance, what we're doing here is we're minimizing the death benefit and we're maximizing the cash accumulation within the program right out of the gate. Okay. You get to choose your criteria for the infinite bank. I think this is kind of like a mic drop moment right here. All right. In June of this year, the FDIC came out with a report stating that the average interest rate that banks are offering for us to keep our money in their banks and their accounts is 0.42% versus the 5.8% that you can earn in an infinite bank with the carrier that I'm thinking about right now. They've paid out a performance rate of 5.8 over the past 3 years. Okay. Now, for those of you who might be thinking, oh, the past 3 years, 5.8, that's great, Jeff. But, Jeff, have you buried something in year 4? Well, let's look back at that. Here's the past 20 years. And the lowest this is paid out in the past 20 years has been 5.6. In years 2009 and 2010, the highest is paid out. It's been 6.83 in 2016, but this past 20 years has included 2008 in the housing market prices. So when we've had people losing their retirement incomes, losing their life savings to the housing market prices, people who are using infinite banking from this carrier were earning at 6.32%. Now, it doesn't end there, because when you go back to these interest rates, infinite banking is providing in compounding interest. And for those of you who don't understand the difference between compounding interest and simple interest, it is simple. Interest is your principal plus your interest, okay? Now, compounding interest is your principal plus your interest plus the interest on top of that interest on top of the principal, okay? Bold Albert Einstein was a big fan of compounding interest. He always said that he who understands it earns it, and he who doesn't understand it pays it. That's actually a little truer now than ever. Okay, I am just wondering, are you still with me? Are you asleep? Okay, I'll unpack that in just a second, but it also illustrated in the question that you might see out on the internet from time to time, which is, would you rather get $1 million today, or would you rather have a penny doubled every day for the next 30 days? Now, I'm not going to make you wait too long on that, because if you take a penny doubled every day for the next 30 days, here's what it looks like at the end of 30 days. It's going to be about $5 million. So now, I'm not suggesting that infinite banking is going to get you 2 pennies or 1 penny into $5 million in 30 days. No, it won't. This is a 200% compounding interest daily versus what this carrier is providing at 5.8% compounding interest annually. But I can assure you that 5.8% annual compounding interest is going to beat 0.42% average of simple interest all day long and twice on Sunday. Next up Infinite banking provides you more value over time. It's the only financial vehicle where your contributions go down over time and your cash value goes up, your death benefit go up, the power of compounding interest, usually using every dollar twice. Now, here's usually where people's brains start breaking. So bear with me, okay? I'm still not going to get very deep into the technical jargon of infinite banking. Okay, I got to take a drink of water. Now, if you had $10,000 in your local bank, Bank of America, Wells Fargo, Trusted, PNC, whatever bank, your local bank that you use, you have $10,000 there, and you take away 90% of that, or $9,000. How much money do you have left over in your savings account? $1,000, right? Okay. Now, if you took this same $10,000 and put it into your infinite bank, and you took 90% or up to 90% of $10,000, that's $9,000 out of that account. How much money do you have left then? Okay, well, it's $10,000 because you're using something called non-direct loan recognition, right? You're using other people's money. You're using the carrier's money, not your money. If you took out $9,000 after you put in $10,000, you're still going to have the $10,000 in there. Now, if I take that a step further, infinite banking is the only financial vehicle where you have one pile of cash that can take money out of right, use it outside the policy, and pay off debts, do finance purchases, go on vacation, use it for loans, and you be other people's bank, whatever you want to do, while at the same time, that same pile of cash is still inside your policy, earning interest, savings for your future to the tune of 5.8%, at least over the past 3 years. We say that it's better than a loan because it's already your money. And we say it's better than a savings account because you get to earn interest on the entire principal, even if you're using money outside the policy. Are you with me so far? What do you think about that? You can listen to the end and share it with your friends. Oh, how much do you think you are paying your financial advisor every year? Using a financial advisor along with this infinite banking, you could double your retirement savings combining these together. Lost my place. What can I say? Or you could just do all this managing on your own with the cash value life insurance by working the system. Ask me how. I'll explain how later. Okay, now here's a traditional banking model that most people should be familiar with. You've got your income and you got your checking account. So your income comes into your checking account, and all of a sudden your bank says, well, if you open up a savings account, you can transfer your money into your savings account, and we're going to give you a few extra points of interest on your money. Your money will work harder for you. So you say, great, I'll open up a savings account and then I'll transfer money into my savings account. And then when my checking account starts running low, I can just transfer money from the savings to the checking. from my savings account and I'll go spend that money. Now, there's two main problems with this. Okay. First off, between these two green lines in your checking account, I think we all pretty much know that the bank is taking our money and lending it to other people. They're marking it up with interest, and they're selling our money to other people to make money. Now, listen to this. Are you ready? Your money is safer in a cash value life insurance than it is in your bank account or savings account. Bank of America has $22 billion in the infinite banking, cash value life insurance, bank owned life insurance, or BOLI for short. Banks only keep 10% of deposits in the bank. Why do you think if people go and try to get their money out, it closes the bank? Because they don't have them. And the bank will only insure up to $250,000. Do you want to have $5 million in your savings account at the bank? And then something happens to the bank, people go to the bank, want their money out, you lose all the money? Life insurance has to have 100% of the money on hand to pay out policies. The life insurance companies, are safer than a bank. Why do you? Hey, I get it. They're in business. They're in it to make money, but they're making money off of your money. And we're not making money off of our money. The other thing is, the issue here is that with this model, it's $1 earned and $1 spent. There's no non-direct loan recognition in traditional banking. Now, if you swapped out your traditional savings account with an infinite bank, so you get $1,500 into your checking account, and you remember that I recommended on some video that you watched a while back that you wanted to maximize your ability to make money on your money and minimize the ability of the bank to make money on your money. So you take $500 and you leave that in your checking account and you transfer $1,000 into your infinite bank, and then you immediately take $900 or 90% out of that 1,000 back out into your checking account, right? You just gave it a SWIFT. You're just filtering that money through your infinite bank and pulling it right back out so that you have $900 out in the world anyway. You still have $1,000 sitting in your infinite banking, earning you the 5.8% compounding interest. Now, that $1 is in two places at the same time. And then the next month comes and you get $1,500 in your checking account so that you keep $500 in your checking account while transferring $1,000 into your savings account on steroids, your infinite bank. And you take another 90% right back out of your infinite bank. So now you have $1,800 outside the policy. All that an original $2,000 still sits in your infinite bank earning interest, saving for your future. And what happens when you do things this way is that 100% of the funds that you're transferring into your infinite bank cash value life policy, even if you take them right back out to recognize immediately your credit is 90% or so of your cash value, is your infinite bank electronic transfer or funds usually takes several business days to transfer back and forth. This is not one of those things where you have a mobile app where you can transfer money from your savings account to at Wells Fargo, Bank of America, whatever bank you use. Then you put it into your checking account and you blink and it's there already. It takes a little bit longer, but you got your dollar in two different places. You got your dollar that you're spending and you got your dollar that you're earning interest, compounded interest on, and you're building up that infinite bank. Okay. You will get money recognized on Wednesday. You submit a withdrawal for you know you want to take some out, and it's in your checking account by Friday. So it's usually 3 business days, sometimes maybe a little longer. So what we're doing is minimizing the amount of time that banks have to make money on our money. And you're maximizing the time that you can make money on your money. The goal here is to always keep the responsible amount in your checking account. You always want to keep a responsible amount there at the same time. You want to maximize the amount of the money that you're filtering through that infinite bank. And in doing that, we've got $1 earned, which is $1 that goes into savings and $1 outside the policy. $2 for every one. Now, look at these two interest rates right now, 11.05% and 5%. If you stayed with me to this point, there's probably a question that's been brewing in the back of your mind, and I'm about to answer it. If you go to bankrate.com and look at what the personal loan interest rate, it's 11.05. Now, if you're borrowing money from your infinite bank, you have to pay yourself back at 5%. Okay. Now don't get discabobbled here. Okay. Wait a second. If I'm not using my money, if I'm using other people's money, if I'm using the carrier's money, do I have to pay that back? The answer is yes. And that's a good thing. Okay. And I'm going to explain why right now. Remember, just a couple of minutes ago, I shared that the past 3-year performance has been 5.8%. So if your cost is 5%, but you're earning 5.8%, how much you actually pay on the loan is a negative 0.8, right? Because you're making 5% on your money that's there, or 5.8% that the money is there, and then you're paying back 5%, okay? Which means that you're getting a positive arbitrage. You are earning income by lending yourself money, right? Are you with me? Do you understand that if you lend yourself money, you are making money by lending yourself money? Okay, let me explain this, okay? Now follow me. This is your side hustle for doing nothing more than what we all have to do, which is to finance our daily lives. You have just become a bank, and you were earning the income of a banker, which is interest. When you get a sizable amount in your cash value life insurance policy, don't let it sit there. Find safe ways to gain and stockpile even more cash. Okay. Let me repeat that. When you get cash value, in your life insurance. Don't let it sit there. Find safe ways to gain and stockpile even more cash. What are some ways you can loan out your cash value amount and earn more cash? What what do you like doing? Have you wanted to start a business? So now let me take this a step further. With an example, let's just say that we want to borrow $20,000 from our local bank down the street or the bank that they're in the town that you're banking with. Now, you call the bank and you start talking to them about borrowing $20,000 and you negotiate that we're going to pay it back over the next 7 years or 84 months. So you're going to go to nerdwallet.com and you'll look up and see what your payments are. They'll look up. I I used it for this purpose. Now I actually thought that 11.5 sounded a little steep. So I went to scroll down this page on NerdWallet and see that they have to say about the cost of personal loans rates. And you can see them here, right? You can look on the bottom. I'm not talking about charging 14%. I'm not talking about charging 21 or 23%. I'm going to give everyone the benefit of the doubt and keep it at 11.5. If I put in here that we're going to borrow $20,000 at 84 months, then you can see that we're going to be paying $342.97 every month over those 7 years. We're going to pay not only $20,000 back, but we're going to pay another $8,000 in financing fees and interest fees, making our full payment back over $28,000. Wouldn't you rather be the financial entity earning some of that 8,000 bucks? I would. Now, what if we took the same $20,000 loan from our Infinite Bank? Here's how it looks. First off, we're not going to pay $342.97 because we're not paying 11.5%. We're paying 5%. And so we're only paying $283. So at the end of 7 years, we're not paying 8,800. We're paying 3,700 in interest back to the bank. Now keep 3,700 in your mind, okay? Now, remember I said that you can only borrow up to 90% of your cash value. So if you're borrowing $20,000, that means that you've got $22,000 in your Infinite Bank. And that $20,000 doesn't go anywhere, okay? When you use it, so over the 7 years at not 5.8% interest, but I'm lowering the interest down to 4%. Remember, I told you that the Infinite Bank from this one carrier hasn't paid out any lower than 5.6%. I'm going to take it down to 4%. That means they're going to be paying you 4% compounded interest over the next 7 years on your full $20,000. Okay. And that is 7,000 bucks. Okay. Now, if you take the $7,000 that you're going to be earning compounded interest from that 22,000 and you subtract the 3,700, that means you made a net profit of $3,200 by loaning yourself $20,000. Are you with me? Are you following? You have heard the saying, a penny saved is a penny earned, right? You just saved $5,100 in interest, right? You take that 8,800 minus the 37, that is 5,100 in savings of interest. Okay. So that's a penny saved. That's a penny earned. You just earned $5,100. Now you take that savings plus your gains of $3,200. That means you made $8,300 loaning yourself 20 grand. Are you comprehending that? Are you with me here? I would repeat that, but you can just back it up and listen again if you choose. Okay. You just made yourself $8,300 loaning yourself 20 grand. Okay. 20 grand. Now, let me apply this to your life. Okay. Say you have 5 grand in your savings account for your emergency fund. You put all 5 grand in to start your own bank in the cash value life insurance. You take out up to $4,500 out and pay off some of your credit cards. And then you get paid from working and you put it in your bank and take some out to pay your monthly bills or pay off the credit card you paid your bills with. You really get the idea, and keep stockpiling your cash in your bank. You get one card paid off and you start on another bill with interest. You pay it off, then you start on your car payment, all the time putting more in your bank account every month to build your cash value. Now, it is time to start your mortgage. You decide that you want to keep about 12 months of bills in your bank. Now you start making short-term loans to businesses and start really adding to your cash value fast. And then you start hitting the mortgage payment hard. You are on the fast track to pay it off with a plan to keep it safe from life's curveballs. This is you getting debt-free on steroids. You are a bank. You are earning the income of a banker, which is interest. When was the last time that you were paid money to loan yourself money? Now let's take this a step further. Look at $3,700, which where does that go? Well, what happens when you put more money into a life insurance policy, it raises the death benefit, and because the death benefit attached to the cash value is also raising the cash value. So you've got a win. You're also got a win with the $3,200 in interest. Now, let's look at this scenario. Remember, I told you that when I first heard this, I had to pay 5% on loaning myself my own money. It almost, well, anyway, almost toppled me. Oh, why? Why am I going to pay 5% interest on my own money? Okay. I didn't think that was a great idea. But we've already covered that. What if you take it a step farther? And instead of paying ourselves 5% interest, we decide that we want to pay ourselves back at the same rate that any other lender would charge us, say 11.5%. What does that do for you? First things first, we take an 84-month loan down to 60 months. The next thing it does is that it earns as much money in interest. It earns us more money in interest. And as we pay more money into the policy, our death benefit goes up, our cash value goes up, and the money that we're making goes up as well. Are you following me still? I know this is a lot to go over. Some of you may want to listen to this a couple of times. And let's take the hypothetical situation, okay? There's a time where my brain's not on the same page as my mouth. Okay, let's take the hypothetical situation that you didn't go with infinite banking and you just took a $20,000 loan from the bank there that you use. But all of a sudden, I'm getting too excited here, okay? But all of a sudden, you come into some kind of financial hardship. Maybe you got laid off. Maybe you were doing something in sports, water skiing, motorcycle riding, snow skiing, whatever. And you have an accident and you can't work for a couple of months. And you don't have the money coming in like you did. So, uh, okay, at that point, you go back to your bank there in your town and you talk to the manager in the corner office who helped you get the loan and you say, "Hey, buddy, can you go, oh, wait a minute, let me back up here." Okay, at that point you go back to the bank into your town and you go to the office manager, the bank manager, whoever that loan officer was that initiated and hooked you up with that $20,000 loan. And you say, "Oh, I just got laid off, or I just had an incident with snow skiing, water skiing, or whatever. And I'm supposed to pay you guys $342.97 a month. But can you lower that to $50 a month for the foreseeable future?" Do you think they're going to say yes? No, they're not going to say yes. They might give you a grace period, but they're still going to come back to the fact that you owe them $342.97 a month. But with this cash value life insurance, the infinite banking, the personal banking, your bank, you own the bank, you own the loan, and you have the power, you have the control, and you have the flexibility to do anything you want. In fact, you can get a bit of a split personality and say, "Self, I know I'm supposed to pay you $342.97 a month, but I would like to take that down to $50 a month. Is that okay?" And then you turn back to yourself and you say, "You know what, self? You're a pretty decent human being. I'm totally okay. If you want to pay back $50 a month as opposed to $342.97 until you get back on your feet financially, or you get back to work, that is totally okay." Now, does paying back a loan at $50 a month as opposed to $342.97 amount extend the duration of the loan? Of course it does. We're not talking about magic here. We're talking about math. And I love math. But you don't have to worry about asking permission from anyone. This is your bank. This is your loan. You don't want, you do what you want with your money. Here's another hypothetical. Let's just say that you took that loan for the bank for $20,000 and you're paying it off and you've got it down to 10 grand. And God forbid you got a rough day. Now I know this is, and on the drive home, you pass away. Do you think that bank there in your town and all of their generosity, a great organization that they are, going to go to your family and say, do you know what? That $10,000 that your loved one still had out, you know, let's just forget about it. Don't worry about paying it back. We're going to wipe it off. The slate clean. That slate will be clean. You don't have to worry about all that. Unfortunately, not. Whether it comes out of a spouse or your estate, ultimately, they're going to say, you know that $342.97 is due on the 15th. We're deeply sorry for your loss. With your bank, this loan, if you took it from your bank, your loan is attached to a death benefit. So let's just say you got $10,000 left on the loan. You got $1 million death benefit. When you pass, the carrier pays off the $10,000 debt, and the remainder goes to your family tax free. Did you get that? Isn't that wonderful? So, how are you doing? You still with me so far? Wait, the best is yet to come. You can pause here and regroup if you need to. Here's another hypothetical situation. What if you took my advice and you're filtering as much money as you possibly can while keeping a responsible amount in your checking account, but you reached your peak of your income earning potential and you're filtering a good portion of that through the infinite bank while maximizing your income and you're minimizing the ability for the bank to earn money off of you. Then you turn 65 or 67. You want to retire. Can you change the amount of money that you're filtering through your bank? Absolutely. Here's how that looks. First, you can see the number one, that premium payments are still split into two pieces. The first go to paying the policy. It creates the structure of the infinite bank. It creates the floor, the ceiling, the walls, and gives us all of these benefits that we're talking about. Anything over and above the cost of the insurance policy just goes directly to your cash value account in your infinite bank. And after the first month of your payments, you can lower that down to $50 a month on the other side. We already talked about that. Your loan repayments, when you're paying loans back to yourself, you have the ability to lower them down to $50 a month or increase them, right? You have that control. You have the flexibility. You have the liquidity to whatever you want to do. And what we're doing here is taking advantages of Section 7702 of the IRS tax code, which basically states that you can overfund a life insurance policy and pull out those funds right back out tax-free, because loans in this country are not taxed, and death benefits and a life insurance policy in this country are not taxed either. In order to stay tax-free, even a bank must be structured by a qualified and licensed professional so that your cash amount never exceeds your death benefits. Because if your cash value exceeds a death benefit of the life insurance policy, that is no longer a life insurance policy. It's a financial investment vehicle. And that is when the IRS steps in and says, guys, gals, you had a lovely life insurance policy. Now we're going to tax you on your profits and gains. And what that's called, that threshold, when you have more cash value than you do death benefit, it's called a modified endowment contract, or a MEC. And we structure these programs so that they don't turn into a MEC. I say that infinite banks act like a Swiss bank, but live locally. Profits and gains within your investment bank cannot be seen or taxed by the IRS. If you're ever sued, funds within your infinite bank are tax-free. They're protected from plaintiffs. Okay. Also, a 529 plan. Also, a 529 plan. Now, a lot of people are saving up to put their kids through college or their grandkids through college with the 529 plan. What they may not realize is those 529 plans count against income. And the more income you have, it means that you're qualified for less federal student funding for FAFSA. So the more you make, the less you qualify to get in student aid, but not with an infinite bank. They can't see into it. They don't know. So go ahead and put your money into your infinite bank and get as much student aid as you want to. You can also start an infinite bank for your children if you want to, and start their bank to build on when they are adults. Let those funds grow while your kids are going to college. And then it comes time to pay off those college loans. Take them right back out of your bank and pay them. Now, that handles the fundamentals of infinite banking, but let's see how it works in action. First off, you got your premium payments. They go into your participating whole life policy or your infinite bank, and it does two things. It gives you a tax-free death benefit, and it gives you a tax-free compounding interest account. It's that all it does. Now, let's look at how banks make money. I think we all pretty much know this, but for every dollar that we put into savings account, it's a traditional bank. If they're providing you 1% simple interest, and I think we're already established that that's not the case for the majority of people, right? 0.42% is the average. For every $1,000 that you put in there, if you're earning 1% at the end of the year, you'll get 10 bucks. Now, over the course of that year, that bank will loan out your money at least 7 times before you see that money again. And so that's 705 they're earning for every thousand of our money that we put in. Now they pay us $10, and so they make $695 at the end of the day. Not a bad business, right? Now, here's how insurance companies make their money. Our premiums go in for the insurance carrier's general account to invest. Now, once that's in their general account, they invest in two specific places. Their retail side, where they loan out money to third-party lenders like credit card companies, banks, auto companies, mortgage companies within markup, and often those loans back to you and me. And they offer those loans back to you and me. If you didn't catch that, take a look at that again. If you don't know what infinite banking is, I hate to say you're already using it, infinite banking. It's just being used against you. Secondly, they have a wholesale side where participating contract and policyholders are given priority to borrow money at a fixed rate like 5%, right? Fixed interest rate. Now, here's how we make money with infinite banking. Let's just say you've got a $20,000 in your compounded interest account and you want to take 6,000 out to go to on a nice vacation with your family. So you take 6,000 out and you decide you're going to pay yourself back over 2 years. Now, over those 2 years, you're going to pay yourself $317.48 in interest fees. Now, your death benefit lets you say let's just say in this example, it's $500,000 is used as your collateral. 90% of your cash value will always be your credit limit. This is not one of those situations where you have $10,000 in your infinite bank and you want to borrow 100 grand. It doesn't work that way. Now, repayment terms are entirely up to you, but in this case, it's 2 years.